Good morning, everyone. It's Stefan and Tom here from Angel Advisory. Welcome to the Real Wealth Podcast. No doubt everyone watching has had some conversations in the past about saving, investing, and about generating returns. But today we're here to talk about an aspect that's a little more neglected, which is the different options for tax structures.
Tax planning, because what's the point of making money if you're going to lose it all in tax?
That's it.
Cool. All right. So when it comes to taxes, I guess it's all about the structure you set up in, or what you invest, or the name you invest through. And that's what we're going to talk about, what kind of names you can invest through. You get discounts sometimes depending on the structures. So we'll discuss that as well. But really, we're talking about the differences between paying, say, 47% tax, which might be the most, or going all the way down to paying no tax. You know, the structure does matter.
Sure.
Because if you make $1,000, would you rather keep $530 of it, or would you rather keep $1,000 of it?
So in that regard, everyone knows generally how it works when it's in their personal name, but we're going to look at the other options beyond that of how the tax can be structured.
Should be fun. Let's hope.
All right. So do you want to touch on, as a baseline, to touch on the tax effect of being held in personal names before we move on to the other sort of more complex structures?
Yeah, cool. So most people do invest through their personal name. So they set themselves up in, I want a share portfolio or own a property in my name, Tom. And then therefore, whenever they get distributed income, it goes onto their assessable income. Now, if you know in Australia, the top tax bracket you can be on is a 47% tax rate, which you sort of want to try and steer clear of if you can. Now, there might not be taxes today, but people's wages grow over time. So even if you invest in that structure at the point today, and let's say you want your wage to go up in 10 years' time, and you still own that asset, then the income is going to be taxed, that assessable income. Only things in your personal name can be good, because if you hold an asset for longer than 12 months, you get a 50% capital gains tax discount. So if you think about it, if I own something and I sell it after 15 months and I made $1,000, then only $500 of that goes onto my assessable income. If I'm on the highest marginal tax rate, then you pay about 23% tax on the sale. So the easiest way to put it can be your name, a joint name, but when you invest in that, you're invested in that structure for a long term. So that all comes down to, what is your marginal tax rate? But yeah, so it's anywhere between 0 and 47%.
Yeah.
That's the most simple one.
Yeah. Beyond that, I suppose the next one would be one that we use a lot, and that would be family trust. So ownership through the family trust and how that differs.
So family trust, obviously, so it's an accounting structure. So it costs money to set up, and it costs money to run each year because it needs to do a tax return. The benefit of a family trust is that you can choose who earns the income in a given tax year. So you can choose whether it be, say, if you've got Tom is in it with his wife. If he gets one day, we'll see.
Yeah, we're leaping ahead, but yeah, my fictional wife.
Talking about the future.
Yeah, okay.
It's so I'm making the money. If I've got someone who's not working, maybe in that year, the person who's not earning an income should derive the income from my investments. Being their marginal tax rate or the assessable income is currently 0. We make $10,000 from our investments. That goes onto their assessable income. They don't have a tax rate. As opposed to the partner who might be making $150,000 a year. Not saying that's your wage. And
it could be, especially if I get married.
We're getting there.
So I'm now married. I'm getting paid more. Carry on.
That person, if you're on 150 grand, you don't want to be earning another $10,000. Because a lot of it's going in taxes. So it's called a family trust or a discretionary trust. You get the discretion to decide who's going to earn the income. It used to be really great where you can choose a whole lot of different people, but it's really changed a lot where you can't choose as many people you can give the money to. But still, it comes down to the individual tax level. You still get the same capital gains tax exemptions as though it's in your personal name, because when it's invested there, and it derives an income or a benefit, it needs to go down through to a person or a beneficiary, being an individual person. So the same tax benefits apply in your personal name, but all you get is that benefit of being able to choose who the money can go to.
Yes, and with regard to what you mentioned before about the beneficiaries, that they've tightened up who that can be. So it can no longer be a situation that it's your second cousin's neighbour's best friend.
Yeah.
It's pretty within the family unit.
It's a lot tougher.
Yeah.
It's a lot tougher. But yeah, so if you think about it, while it doesn't make sense to a lot of people straight away, if you look at where people's incomes are going in the future, and this is why financial planning makes sense, it's in 10 years' time, if we all both want to be earning really good money, or I know that I'm going to be earning a lot of money, we might want to invest it through a family trust because it's going to create more tax benefits in the longer term, as opposed to just right now and in the short term.
Yeah.
So that's why a lot of people, or we set up a few of them, because it's that long-term objective.
So that's family trust / discretionary trust. The next one we want to chat about is company.
Yeah.
Which I think not many people would be familiar with.
Yeah. So it's a company, a lot of people set up companies or have like an ABN, and you earn an income from your company if you're on a sole trader ABN. But once you're running under a company, if you're a small business, your tax rate is 25%. But some people want to invest through a company. Now, investing passive income through a company, it's okay, but you get a tax rate of 30%. 30% is not great, but it's better than if you're on a high marginal tax rate in your personal name.
Yeah.
When you're investing in long-term assets, so like shares, property, and things like that, in your personal names, you get a capital gains tax discount. So half of it, 50% CGT discount, if you hold the asset for longer than 12 months. When it's in a company, you don't get that. So it's taxed at 30% no matter what.
Right.
So you can have more tax implications if you're holding long-term assets. For income-producing assets, it can be good because your tax is capped at 30% in there. It's got to come out eventually to the person, but it's that loss of a discount that you get by investing through a company.
Yep.
But still, 30% tax rate can be pretty good.
Yeah, okay. So the next one, I'm actually not familiar with, but we want to chat about how it works through an investment bond.
Yeah, investment bonds are cool. So investment bonds are really great for high income earners, people that want to invest for future generations. Essentially, we call it a non-estate asset. So it doesn't go into your tax return.
Yep.
You've got a completely different tax file number.
Right.
Normally within these investment bonds, so the governments love it because it's made to be a long-term investment. Long-term investment in the realm that if you hold this asset for longer than 10 years, you pay tax along the way and you pay no capital gains tax extra when you pull the money out.
Right.
Now, the tax you pay along the way can be a maximum of 30%. Some of the different investment bond providers can have internal tax of a lot lower than that, all the way down to 0. But importantly, none of the income it makes or the growth you get from it will go onto your assessable income or your personal tax returns.
Right.
So if you think about it, if you're a really high income earner, do you want to invest in your personal name where you're going to be taxed a really high tax rate?
Yeah.
Or if the money's invested for a long term, would you want to go through this investment bond structure, which has a different tax element to it?
Create the separation between yourself and the investment bond.
Exactly right. Yeah. So you separate your investment portfolio. So that's where you can get even better, more tax concessions.
Yeah.
By having the tax paid investment bond structure where you get capped at 30%, but it can be a lot lower.
Yeah. Is that common for it to be under 30?
Yeah. So it all matters about the manager and the investment within it.
Yep.
Especially with Australian equities, there's franking credits that come through dividends for Australian equities, and therefore that cleans up a lot of the tax scenarios.
Yep.
But yeah, different companies are made different in this environment. So it's all about choosing the right provider that you go with.
Yeah.
That can have more tax concessions.
For sure. Next one is relevant to everybody because everybody's got superannuation. So the tax in super.
We love super.
We do, don't we?
Yeah. Our objective is to keep taxes as low as possible, legally, of course. And superannuation's probably the greatest environment because me and you, we're young, we're accumulating our wealth and we're growing.
Yep.
So all earnings in super are taxed at 15%. So that's income that comes through. So if you've got an investment, it makes $1,000. Then 15% goes to the ATO and you're left with $850.
Yep.
But remember how I spoke before about the capital gains tax discount? So if you hold an asset for longer than 12 months, you get a 50% discount on your personal name.
Yep.
Works a bit different in super. So while your tax is 15%, you get a 1/3 discount if you hold the asset for longer than 12 months. That's what a lot of people don't know. So your tax becomes 10%.
Yes.
So if you made $1,000 on an asset you held for longer than 12 months, then 10% will go to the ATO. You'll keep $900 of it.
Yep.
Which is a lot better than the other structures. And that's why we love super, because even though you're growing and building your wealth, your tax rate is lower, which means if you look at a long-term benefit and on an each year basis, you're getting those little incremental benefits over time is going to make a dramatic difference in your long-term scenario.
Yeah.
So we love super.
Yes. And that leads nicely into the final one, which I think is an absolute winner, which is pensions within super.
We love pensions.
Yes. Even though we're miles off.
We're a long way away, but
we'll get there.
So super's such a concessional environment because you can't touch the money.
Mm.
You can't touch the money until you're 60, 65, met what's called a condition of release. And when you've met this condition of release, and we're just going to say it's at 65 and not talk about the other ways to get it, a certain amount of your money in super will have tax-free earnings, and you can pull the money out tax-free as well, as much as you want.
Mm.
So I'll give you an example. If you buy something, people love buying properties, right? So let's talk about a property. You buy a property for $500,000.
Yeah.
And you own that property in your super fund for 20 years.
Mm.
And let's say then you sell it when you're retired at 70. So this is a 50-year-old.
Yeah.
And you're in pension phase. Then if that $500,000 property has grown to $1 million, then in your personal name, you get a 50% discount on that. Whereas in your super, the entire growth is tax-free.
Yeah.
So you get all of that back.
Yeah.
There are limits on how much your super balance can be. So at the moment, it's something called a transfer balance cap. So you got to have a super balance of less than, say, $1.7 million to have tax-free. After that, it goes back to the 15% that I just spoke about.
Yep.
So there's limits on it because it's so good.
Yeah.
But if you're in a long-term asset you want to hold for a long term, you can have stocks in there as well. Buy stock, just let it grow, and then sell it when you're in pension phase. Then all the earnings on that, when you sell it, can be tax-free.
For sure.
And then when you're 65 and you want to generate income, and you've got this big sum of money that you say is generating, let's say $100,000 a year, in your personal name, $100,000 a year is just like you're getting taxed $100,000 a year as an income. So like you're earning a wage of $100,000 a year.
Yeah.
So you might pay $30,000 a year in taxes. Whereas in super, that $100,000 comes through tax-free.
Yeah.
So hugely beneficial.
Yeah.
That's why we love super.
That's our favorite one.
And
save the best
pensions.
one for last.
Yeah.
Oh, very good. Okay, so just to wrap up, we've covered off on the tax structures of personal name, family trust, company, investment bond, and then super and pensions in super.
Yeah, exactly.
Excellent.
Now, for anyone out there, if you're looking to determine what's the right structure for you, please go and speak to a financial planner. Please remember that no information in this is personal information or personal advice. This is all just general information. But if you are looking for that personal advice, please go and contact your licensed financial planner. I hope you've enjoyed this today. We've changed it up and got Tommy involved. So, mate, thanks for stepping up. This is your first one, and you nailed it.
Thank you. Thank you very much for having me, for sharing your insights, and looking forward to plenty more.
All right, beautiful.
Cheers.
Thank you, everyone.
Thanks.